Okay, the stream is starting on Facebook, so you guys can get started when you are ready.
It is my pleasure today to welcome everyone to our program with FHFA Director Dr. Mark Calabria. We will follow his comments with a panel discussion hosted by Kelsey Ramirez of Housing Wire magazine, featuring leaders of civil rights groups. Dr. Calabria was well known before he became director of FHFA in 2019, having been deeply involved in housing and housing finance issues for decades. He has held key roles with the home builders, the realtors, Cato Institute, the Harvard Joint Center on Housing, and served as Deputy Assistant Secretary at HUD. Beginning in 2017, he has served as the Chief Economist for Vice President Pence. He also previously served on Senate staff and was as a key member of Senator Shelby's staff, advising him on housing finance and other economic issues. It's appropriate that he was selected as FHFA director in 2019, as he was highly influential in the drafting of HERA, which fundamentally reformed the regulation of the GSEs, the structure of their regulator. As FHFA director, Dr. Calabria has faced many issues, including two very large ones. The first is the ongoing operation in the future of the GSEs. That one he expected. The other, of course, has been the second once-in-a-lifetime event to hit us in the last dozen years, the COVID crisis. In his oversight of the GSEs, he's worked to improve the operation of the fair housing goals, to prevent affordable housing credit from being earned without true impact that really helps families. And he's continued the critical capital magnet and trust fund contributions. On the GSEs, he's taken steps to provide more capital and to plan for the end of conservatorship. With the COVID crisis, Dr. Calabria was one of the first to enact steps to provide aid to American families, protecting homeowners and renters with protections from displacement. And he's continued being vigilant to reduce the impact of COVID on them. Today, many families, though, remain housing insecure, and these burdens have, as is too often typical, hit families of color the hardest. It remains to be determined how in this crisis we will preserve and expand homeownership and housing security to prevent further increases in the racial housing gap, and how we will begin to address the historic and continuing structural barriers that have produced that gap. Dr. Calabria is known for his thoughtful and informative presentations, and we deeply appreciate his sharing with us today. Dr. Calabria, thank you.
Well, Michael, thank you so much for that very kind introduction, and thank you for inviting me. First, as you mentioned, I think I was somewhat prepared, or at least laying the groundwork to be prepared for one crisis, and then we got another. But I really want to take this opportunity to thank you and thank everybody on the panel and many of the listeners. This has really just been such an amazing response in the housing and mortgage community, to this pandemic. I'm so honored to have been part of a partnership with so many people and trying to focus on day one, trying to keep people in their homes and allowing them to socially distance. And so we've been one piece of this puzzle, but I really do want to thank everybody who I know has put in extremely long hours and worked around the clock, particularly back in March and April. But again, a lot of work in that effort remains to be done. So I really do want to recognize everybody else's efforts in this regard. And lastly, before I get into the substance of much of this, just say how proud I am of the FHFA staff. They've really just done an amazing job, worked overtime, and really responded and rose to the occasion. So I feel very fortunate to head an agency that really was very focused on this. And as you mentioned, we at FHFA, we acted even before there was a national disaster declared. We worked with Fannie and Freddie to try to help borrowers and renters stay in their homes. We've been focused on that from day one, while also trying to make sure that the mortgage market can function during this crisis, as well as get the mortgage market on sound footing in a post-crisis world, in a post-COVID world. One of the things that we've really taken to home is try to learn the lessons of the 2008 financial crisis and Great Recession. I came in the door in April of 2019 and said to my staff right away, we need to make sure that the servicing industry is where it needs to be to respond to a crisis. And we've tried to make sure from day one that that's the case. We've tried to make sure that all of our decisions are data driven. What do the numbers tell us? What's the analysis say? How do we make sure we're putting the safety of borrowers and renters first in making sure that anybody living in a property with a Fannie Freddie backed mortgage, that they would be able to stay in their home. I think it says a lot to the standards that we've set up that a lot of other actors in the mortgage market, such as those that hold loans on portfolio or in private label, have adopted much of the standards that we first put out. And that's been another emphasis on how do we come up with a common set of standards. We've worked with our partners at FHA, for instance, and USDA and VA to try to make sure that we have as much uniformity as possible to make sure that borrowers get treated the same wherever they go. So I want to quickly take a few minutes and just mention some of the things we've done since March. Foremost was suspending all single-family foreclosures and foreclosure-driven evictions. There are approximately 200,000 families facing foreclosure when COVID hit, pre-COVID, and we wanted to make sure that those families could stay in place, that they could essentially continue to social distance and be safe in this environment, and we facilitated that. And we will continue to facilitate that. In fact, we extended those protections to the rest of the year. And if we need to extend it beyond December, we certainly will. Obviously, we all hope that things continue to move in an upward direction. For borrowers who were adversely impacted, a number of borrowers lost their jobs. We know there's tremendous amount of job loss as a result of COVID. And we wanted to be able to give borrowers a timeout up to 12 months forbearance where they could stop paying their mortgage if they chose. We wanted to come up with a number of modification options and repayment plans. One of the things that we really wanted to take away from this financial crisis of 2008 was we also wanted to make sure that no borrower faced payment shock whenever they became current again on their mortgage. And so one of the things I really want to emphasize that's so important, if you have a Fannie and Freddie mortgage, if you take forbearance and you come out of it, we've got this set up so that you will not have to pay it all back at once and that you can return to the same monthly payments you had before. It's one set of options. We've had actually a large number of homeowners come out of forbearance and actually pay everything back. It's not most of them, but the surprisingly large percent have. And we've had a number that have gone into what we call the payment deferral option, where essentially it's tacked on to the end of your loan. We've also, one of the other lessons of 2008 we really wanted to avoid was we didn't want borrowers to get the runaround with endless rounds of paperwork negotiating with their servicer. We all remember too many of the problems with the endless rounds of HAMP and HARP and other modification programs. Paperwork were lost for borrowers were denied access. And that's why we very early decided we were going to do this on the honor system, where borrowers would be asked, have you suffered a hardship? If you have, we're going to let you in. And I can say from the data I've seen, there is no evidence that this has been abused in any large scale. Largely, the people who have signed up for forbearance have been people that have needed it. And one of the reasons we've also emphasized from the beginning is if you can pay your mortgage, you should pay your mortgage so that we can, again, focus our resources on those who cannot pay their mortgage. For instance, about a quarter of those in enterprise-backed forbearances have continued to pay their mortgage throughout the forbearance and really just took it as an option. For those borrowers who did pay throughout their forbearance and have been current during that time, we treat such borrowers as if they were current whenever they want to get a new loan or refinance so that there's no penalty to their credit rating or any other. And this was a really big change from previous crises where if you took forbearance, you had to wait as much of a year to refinance. And so we wanted to eliminate that barrier this time around. And we also wanted to make sure that we were paying close attention to the data so that we could change our policies. And maybe to help put this in perspective on where we were, in the middle of May, Fannie and Freddie single-family forbearances peaked at just over $2 million in the middle of May. Interestingly enough, we in March said that that's about where we thought we would be. And currently we're running about 1.4 million. And again, most of these borrowers have transitioned back to being current. Very few have remained problematic loans. We've also took important steps for renters as we recognize the majority of job losses related to COVID have actually been among renters rather than homeowners. And this really required a unique response. And so for the first time ever, we developed a nationwide multifamily forbearance program where essentially if the landlord entered forbearance, they would agree to not evict anybody for non-payment of rent. So we would give the landlord relief with the requirement that the landlord would pass along that relief to their tenants. In order to make sure that tenants would know whether the properties they were in were covered by the CARES Act or covered by forbearance programs, we created an online lookup tool so that renters could quickly figure out whether they would be protected or not. So far, we've had about 170,000 multifamily units that have been protected under forbearance programs at Fannie and Freddie. We've also allowed in July multifamily property owners in forbearance to extend for an additional 3 months on the condition that they adopt a number of stronger renter protections. And in August, FHFA announced that multifamily landlords with new or modified forbearance must notify tenants of their rights under these forbearance agreements. We've also directed Fannie and Freddie to help clarify consumers' options. We've made an updated COVID-specific servicing script. So the hope is that any borrower who calls any servicer, if it's a Fannie and Freddie loan, they get the same set of answers, they get the same set of options. We've also translated these forms and these scripts into Chinese, Spanish, Vietnamese, Korean, and Tagalog, making sure that we had as much available to help families in this environment. We've tried to consistently communicate to servicers and to the public, for instance, that no lump sum is required after the end of a forbearance agreement. We also partnered with the Consumer Financial Protection Bureau to launch the Borrower Protection Program, which allows us at FHFA to leverage CFPB's consumer complaint database so that we can identify problematic servicing practices among Fannie and Freddie servicers. Also working with FHA and CFPB, we helped create a website that consolidates federal information about mortgage relief options, renter protections, and just as importantly, how to avoid scams during this environment. We've also taken a number of steps to support the proper functioning of the mortgage market. For instance, we instituted a 4-month limit on mortgage servicers' obligations to advance principal and interest on loans in forbearance. This has provided stability and clarity to the mortgage market. To support lenders' liquidity, FHFA enabled the enterprises to purchase certain single-family mortgages in forbearance currently through September 30th. I will note prior to COVID, mortgages either in forbearance or delivery were ineligible. It's simply never been purchased by Fannie and Freddie before. We thought it was important to provide this option to be able to give servicers, lenders liquidity so that they could continue lending in a responsible manner during this time. To help ensure that borrowers qualify for mortgages they can afford, FHFA will share with CFPB the aggregated data on loans that enter forbearance before delivery to the enterprises. This will allow us to fulfill our obligation under the so-called QM patch to ensure that loans sold to Fannie and Freddie are complying with the intent of Dodd-Frank's ability to repay provisions. I am proud of FHFA's response to this pandemic. Our actions have helped homeowners, renters, and the housing market deal with this crisis, but it's certainly worth recognizing that there has been a cost. You don't call it doing the right thing because it's easy or because it's cheap. It's doing the right thing because it's often hard and expensive. And to give you some sense of what these policies have cost, we estimate that they will at least cost at a minimum $6 billion for Fannie and Freddie. About $4 billion of that is loan losses from projected forbearance defaults. Over another billion has been from the foreclosure moratorium. I mentioned the 200,000 families that were facing forbearance for the past 6 months. For instance, we've paid their property taxes. We've kept them in their homes. That was the right thing to do. But of course, doing the right thing in this case has had cost, and we recognize that. And another billion in forbearance expenses have been accumulated in servicer compensation. To cover these projected losses, starting on December 1, Fannie and Freddie will be charging lenders an adverse market fee of 50 basis points on a modest number of refinance mortgages. The first thing to understand about this fee is that it's charged to lenders, not borrowers. It's the lender's prerogative how much of any of this fee is passed along to borrowers. But I really want to emphasize these losses are the result of policies that have helped millions of Americans stay safe in their homes during a global pandemic. I believe it's the right thing to do to pay for those programs and to facilitate families being able to protect themselves from a pandemic. I'll note Congress has provided Fannie and Freddie and FHA with no funding to be able to carry out these activities, but Congress has provided us with the responsibility what to do in a situation like this. And this is where Fannie and Freddie's congressional charters require explicitly that expenses must be recouped via income. Most financial institutions are required to maintain reserves of loss-absorbing capital exactly for situations like this. By contrast, Fannie and Freddie were required for years to send all of their earnings, all of their net worth to the U.S. Treasury. As a result, when I walked in the door at FHFA, Fannie and Freddie were combined leverage of 1,000 to 1. This is why we've been working hard to enable the enterprises to build capital. If the enterprises had still been leveraged 1,000 to 1, they would have failed when COVID hit. Fortunately, we were able to build capital during that time to avoid an immediate failure of Fannie and Freddie. Also worth saying and observing that we have been able to build even more capital when COVID hit. We've been able to provide even more support to those in need. FHFA has tailored this fee to ensure that low-income borrowers can continue accessing record low rates to reduce their monthly mortgage payments. Exempt from the fee are borrowers with loan balances of $125,000 or less, nearly half of whom are at 80% of area median income or less. Also exempted are the affordable refinance products Home Ready and Home Possible. The fee increase was originally scheduled to go into effect September 1st, but after listening to feedback from stakeholders, including the Center for Responsible Lending, FHFA delayed implementation until December 1st. This recognizes that Congress may take this opportunity to review alternatives to this fee. Moving forward, we will continue to keep a close eye on the data and update enterprise policies to remain responsive to the needs of borrowers, renters, and market participants. At the same time, FHFA must continue to fulfill our statutory responsibilities that guided our work well before the outbreak of COVID-19. America's housing problems did not begin with and will not end with this pandemic. As you know very well at the Center for Responsible Lending. In April, you put out a document with policy recommendations that have aimed to address many of these pre-existing problems. Chief among these challenges is the lack of affordable housing across the country. Housing is a function of what I see as the 3 L's, land, labor, and loans. The factor that drives up the cost of housing more than any other of these is the accumulation of burdensome local regulations, including zoning, land use restrictions, building codes, and permitting requirements. But our nation's housing finance system also has a role to play in improving affordability and access. Fannie and Freddie, while private companies created by Congress, they were created to perform a public mission. A core element of that mission, stated in the congressional charters, is to, quote, promote access to mortgage credit throughout the nation. They do this by buying mortgages from lenders, which allow more mortgages to be made, and they do this by guaranteeing the principal and interest payment on behalf of borrowers to investments in mortgage-backed securities. For most families, homeownership is a key step toward achieving financial security and building a brighter future for their children. But we certainly must remember, particularly in the aftermath of the 2008 financial crisis, that homeownership, when it goes bad, can be financially devastating, leading to foreclosure, eviction, distorted credit, displacement, and often worse. The factor that makes the biggest difference between these two outcomes is not the mortgage rate today, but the borrower's ability to repay a loan in the future as recognized under Dodd-Frank. There is no mortgage rate low enough to make homeownership beneficial for a borrower who experiences a severe financial shock like unemployment before building any meaningful equity in their home. This is borne out by the fact that borrower debt to income has been one of the strongest predictors of forbearance uptake. This is not some theoretical point. It was the lived experience of millions of families just after the financial crisis of 2008. I know part of today's event focuses on the racial homeownership gap and the closely related racial wealth gap. These gaps should be and are serious concerns. But when the conversation turns to solution, we must remember the lessons of 2008 when the housing crisis shattered the financial future of so many families and communities. It all started with a push homeownership at almost any cost, even if it meant saddling families with extreme levels of debt. While leverage maximizes the upside in good times, it maximizes the downside in bad times. And 12 years later, we know that a major driver of today's racial wealth gap is that minority households went into the 2008 crisis with extremely high levels of mortgage debt. as was recently discussed in a new Urban Institute study on the racial homeownership gap. Of the African American first-time home buyers with mortgages originated between 2005 and 2008, nearly 8% went into foreclosure between 2007 and 2009. That is 76% greater than the rate for first-time white home buyers. And the net worth of white and Asian households declined 38% between 2007 and 2011, while those for minorities overall declined 71% across minority households. Again, we have to recall that the financial crisis and the Great Recession had a devastating impact on minority households, on wealth, and a very big contributor to that was the amount of leverage that households had going into the crisis. Looking back on the buildup of the housing bubble, it is clear that the biggest threat to the financial future of low-income minority households was not just getting into the mortgage market, but staying in the mortgage market. And I think it's so important that we make sure that the homeownership opportunities that we provide are sustainable. Because again, when the bottom fell out, it was those families that were left to pick up the pieces. Another one of Fannie and Freddie's core purposes stated in their congressional charters is to, quote, provide stability to the housing finance system. But to provide stability, they must themselves be stable. And in 2008, Fannie and Freddie were anything but stable. The failure of Fannie and Freddie in 2008 undoubtedly made the housing crash even worse. My job and my statutory mission is to make sure that Fannie and Freddie never again fail the millions of families whose financial futures depended upon a stable mortgage market. To do this, Fannie and Freddie must build capital. Capital is the portion of the enterprise's funds that is not owned to anyone and is reserved as a buffer to protect against unexpected losses. This is the core purpose and function of capital. Capital absorbs losses and enables Fannie and Freddie to continue supporting borrowers when other sources of credit disappear. The more capital Fannie and Freddie have, the more losses they will be able to absorb and the more support that they can provide to borrowers. As I've said, we have made progress in building capital at the enterprises. Their combined leverage ratio went from roughly 1,000 to 1 when I started 17 months ago to 250 to 1 at the start of this year. Still too high, but moving in the right direction. Much work remains. In their current condition, Fannie and Freddie will likely fail in a severe downturn in the housing market. This May, FHFA took a critical step towards solving this problem when we released a reproposed capital framework for Fannie and Freddie. This framework targets an eventual 25 to 1 leverage ratio, or capital equivalent to roughly 4% of total assets. Some would say this is not enough. Some would say it's too much. I think it's important to keep in comparison that 25 to 1 for Fannie and Freddie is still twice as leveraged as the 12 to 1 for our largest banks. But this is the amount of loss-absorbing capital that FHFA estimates each enterprise would need to maintain a viable going concern, both on its balance sheets and the eyes of creditors and counterparties, amid a housing price shock on par with the 2008 crisis. Meeting the requirements in this capital framework would make Fannie and Freddie financially safe and sound. This must be our goal. Safety and soundness at the enterprises means safety and soundness for millions of households and renters across America. Capital is what will allow Fannie and Freddie to support homeowners and renters who fall on hard times through no fault of their own, like the situation we are facing today with COVID. Capital is what will allow Fannie and Freddie to continue buying and guaranteeing mortgage across the economic cycle. This is the foundation of reliable mortgage credit across times of financial distress, and it is critical for low-income families who need to refinance their loan or downsize their home in order to stay afloat. And capital is what will allow Fannie and Freddie to weather a crisis and continue doing their part to help ensure all Americans have an affordable place to call home, whether it's rented or owned. I can quote for a second Senators Sherrod Brown and Elizabeth Warren, quote, "To the families who were affected by the last financial crisis, capital requirements were not some abstract ratio found in the pages of the Federal Register. They represented the difference between families and workers losing their homes, jobs, and livelihood. The same is true as the country faces a new economic crisis by COVID-19 pandemic," end quote. I could not agree more. The primary beneficiaries of a well-capitalized financial institutions are the very people served by those financial institutions. If we look at the experience of America's largest banks over the last decade, those banks that entered the 2008 crisis with strong capital continued to lend, while those with weak capital pulled back. It's important to remember a well-capitalized financial system will reduce the likelihood of crisis and associated recessions. I believe the avoidance of crises and recessions benefits all families, but particularly low-income and minority families who are the first to lose their jobs and savings when disaster hits. The same is true of the enhanced capital standards that we developed for the private mortgage insurance industry that FHFA is currently working to update, and is the same with the capital framework that FHFA is putting in place for Fannie and Freddie. As you know, the comment period for the rule closed at the end of August. Now FHFA is hard at work with a public comment and begin finalizing the rule. As part of this effort, we will hold 2 online listening sessions. These are additional opportunities for the public to provide feedback on the new capital framework. The first listening session on September 10th will focus on credit risk transfers. The second on September 14th will focus on affordable housing access. All interested parties are encouraged to participate. The press release announcing the listening sessions is a link to request a speaking slot. You can find this on FHFA's website, fhfa.gov. Before I close, let me say that I believe the past several months have proven that FHFA is not just willing to receive input and feedback from stakeholders, but we believe it is essential for us to do so. This is not just a statement to the hardworking employees of FHFA, it's a statement to how I believe we must operate as an agency. Transparency and accountability are at the top list of what I believe we need to achieve as an agency. And we need to be able to be informed to do our jobs correctly. I'm grateful for the work, Mike, that you and others at the Center for Responsible Lending are doing in your partnership during this time. And I look forward to continue engaging with you and other members on your members on the capital rule, COVID response, and of course, the much more that needs to be done to bring stability, long-term stability to our mortgage finance system. With that, thank you. And Michael, I really appreciate the opportunity and wish you and everyone else the best of luck.
Thank you, Dr. Calabria, for your work and your insights that you've shared today. We deeply appreciate them and your joining us today. We will turn next to our panel discussion, which is moderated by Kelsey Ramirez of Housing Wire. She is the editor of Housing Wire magazine and one of the key journalists in the housing finance world. She generously agreed to moderate the panel today. Kelsey, let me turn it over to you.
Thanks, Mike, and thanks so much to Director Calabria for those opening remarks. I'm excited to dive further into this. And then let me just start off by introducing some of our panelists. We have Keisha Bailey, the Executive Vice President of the Center for Responsible Lending, Steve O'Connor, the Senior Vice President for Affordable Housing Initiatives at the Mortgage Bankers Association, Mark Morio, President and CEO of National Urban League, and Norena Limon, the Senior Vice President of Public Policy and Industry Relations at the National Association of Hispanic Real Estate Professionals. It's a mouthful. So thank you all, everyone, for being on with us today and agreeing to participate in this panel. I'm excited to get started. So the first question I will direct to Mark first, and then Nikita, if you want to follow up with it. It's in today's environment, many Americans are being forced into economic hardships through no fault of their own. And this pandemic is hitting communities of color and low-income communities especially hard. What policies are being enacted, or would you like to see enacted, that would help some of these most hurting communities stay in their homes and weather these economic hardships?
Thank you so much, Kelsey, for being here as our moderator today. Mark is going to be joining us from another program, so I'll kick us off and then he'll jump right in. So clearly, before COVID even started, 40% of Americans, including many African Americans and Latinos, had yet to recover from the Great Recession. This pandemic has fallen disproportionately on the same communities. And for far too many of these families, residential segregation made them more susceptible to this devastating disease and to the mistreatment in the criminal justice system. A just recovery must ensure that Black and Latino families are not left in a worse position. Families of color deserve their fair share of federal stimulus dollars. And the Senate needs to swiftly act and pass the HEROES Act provisions, which has $75 billion in hardest hit relief for families struggling, to make sure that those homeowners can avoid foreclosure. These funds have to be equitably distributed, unlike the Home Affordable Refinance Program and the HAMP program that resulted in the last recession. Those programs did not help lift out communities of color, and as a result, Black and Latino home buyers and their communities actually lost $1 trillion of wealth. We also need the CFPB to be really active in informing families of the relief available under CARES. There is really significant support in the CARES Act, yet according to a survey released by Fannie Mae, many families don't even know what the existing CARES Act preventions actually are. So the CFPB should do a much better job of really providing that education. It was good to hear the director mention that there's a requirement now for servicers to do this outreach and ensure borrowers have this knowledge. We have to be honest about the fact that to date that has not been the case, and we need to see that increase dramatically so that families can actually remain in their homes. We also want to make sure that people know, like the director mentioned, that the relief for Fannie and Freddie backed mortgages is extended to December. So landlords that are actually getting this relief need to make it clear to their tenants up front that they have this right to remain without eviction in their homes. This is a public health pandemic. We need people to remain in place so that we can all be safe. And unfortunately, for far too many Black and Latino families, they've not had the option to work from home. They have been the essential workers that our economy has needed. So every effort must be taken to strengthen these families and make sure we don't spiral out of control.
Keisha, that's great information. Keep in mind, I think.
Hey, good morning. Good afternoon.
Hi, Mark. How are you?
Hi. All right. Hey, Mike, Keisha, Kelsey. Hi, Marina.
Hi, Mark.
Good. Everybody's on point.
Mark, actually, if you want, I can turn this question over to you now. I had you on the list as well for this question. Basically, it's just what policies that will help communities of color and low-income communities during this unprecedented pandemic, and they're getting hit especially hard.
Yeah, I'm sorry. Restate the question. I'm fighting my neighbor's lawnmower.
It's the reality of the life we're living in right now.
Yeah, right. Fighting my neighbor's lawnmower, blower, or whatever. Go ahead. I'm sorry.
Fine. Just what policies are either currently being enacted or do you think should be enacted that would help communities of color or low-income communities during this pandemic when they're being hit especially hard by orders?
Thank you. I'm sorry I'm late today. Good to be on. Always much appreciation to the Center for Responsible Lending team for their advocacy and just brilliance on these issues. I'll show it short term. Right now, we need a moratorium on foreclosures and evictions. We need a moratorium on utility shutoffs. We've got to create some short term, a bulwark, some relief against an even worse situation. And my argument is, and that the price to overall society of moratoria is much greater than the cost of trying to fix or try to respond to a situation where millions of people have no roof over their head. Imagine what that would mean. That would mean homeless shelters being overrun, people doubling up, tripling up, people being dislocated from communities because they may have to move to another community to go live with friends and relatives. It could mean families splitting up. Got to send the kids someplace. You have to go another place. The devastation of mass foreclosures and mass evictions would be devastating. So in the short run, we obviously need to do that. And I think it's very short term, but it's very essential to doing it. Now, I realize, and my own hometown, New Orleans, is a perfect example of this. Many of the landlords are not big commercial property owners.
Mm-hmm.
They're small businesses. They're people that own 2 or 3 units, 3 or 4 units. So there's a hardship placed on the small landlord, meaning they could end up in default of their mortgage. And then you have a cascading effect. So I really think it's got to be looked at in terms of whether there can be some relief for small commercial landlords, right? In addition to relief for homeowners. I think this is really essential. I learned over the weekend that Amtrak is planning 2,000 layoffs, that the airline industry and some of the hospitality industry that have done some layoffs are poised to do even deeper layoffs. If you follow the papers, it's clear that without any relief, many city governments, county governments, and state governments are going to have to do mass layoffs. You know, the fact of the matter is that the economic devastation of COVID and the response has not been completely felt by us. And there's a sort of an artificial spin going on that there's a V-shaped recovery and that the economy's coming back, which we all want the economy to come back, but which doesn't factor in the fact that all of this stimulus money and PPP money and unemployment comp money help to kind of, you know, cushion for some the impact of a devastating set of job losses. So I think we ought to focus in the short term, and we can get to the conversation about the long term, you know, in a minute. But I think, you know, being real practical about this is a crisis where you have to keep a roof, help people keep a roof over their head.
And yeah, I know in the short term, a lot of people are just trying to look at how they're going to make it to the next day, the next week, when they're not receiving these paychecks, when we've seen this massive layoffs. So that's a great point. My next question surrounds the GSEs and what initiatives they can put in place to help put lenders in a better position so that they can help make homeownership and refinances more available to low and moderate income families and families of color. So Steve, I'll start with you on that question. What are some of the best things that they could help make available to lenders?
Yeah, so thank you. And I'll talk a little bit more about this later when we talk about refis. But first of all, thank you for the opportunity to be part of this discussion. And thank you particularly to CRL for their leadership on a lot of these issues and my co-panelists. So just borrowing from Mark's construct of short-term and long-term, you know, the GSEs, more important, I think, longer-term need to be a stable player in the financial system. And there's been a lot of discussion. Mark Calabria talked about this, about the short-term priorities that they've had to attend to as a result of the pandemic. But we shouldn't lose sight of the fact that they're still in this state of limbo as a result of the conservatorship. And they've been, under the leadership of FHA, been implementing reforms to allow them to continue to play the key role that they play in the marketplace. But there are the need to kind of solidify and make permanent some of these reforms, such as ensuring equal access to all size lenders to the secondary and capital markets. This will ensure that you have a robust and competitive primary market and therefore ensure better pricing opportunities for consumers. Right now, you've got a quasi-government backing of the GSE MBS through the preferred share purchase agreement in place where the GSEs have access to a line of credit with the U.S. Treasury Department. But we would like to see that made into a permanent explicit backing of the MBS, which has been a topic of GSE reform for years. And we think the GSEs need to be regulated in terms of their pricing akin to a utility so that they're ensuring a stable role in the marketplace and not so much seeking growth. And this is something that CRL and others on this panel touched on in their joint letter on the capital standards. And then the last thing, this is really more about Congress than it is about the GSEs, but I'd be remiss not to mention it. But there's been this temptation in the past to look at G fees, the guarantee fees, and the income generated by those fees as a source of income for non-housing priorities. You saw this several years ago when Congress tapped into some of the G fees, created a add-on to pay for a payroll holiday, a tax holiday. And we have to ensure that we avoid the temptation of using those G fee revenues for non-housing expenses. And so I think I'll stop there. In the shorter term, the last thing I would mention is the duty to serve obligations, which are critical to affordable housing. Due to the pandemic, they've basically been allowed, the GSEs, to make modifications and to extend into next year the current duty to serve obligations. Longer term, that's going to be a key piece of the equation in terms of helping communities of color and LMI borrowers.
Just to dig in a little bit more and maybe get more specific on one of your points, is it in your opinion then that the GSE should put their exit from conservatorship and that focus on hold for the time being?
Well, I think right now, to a large degree, they have to because of the urgency of the pandemic-related challenges in the housing market. But they should continue to go forward with the reforms that they've implemented, the parity and GFI pricing, for instance. That should be sustained. Credit risk transfers and de-risking the GSE book of business, that should be maintained. So there were things they initiated pre-pandemic that should continue to go forward. But I think right now it's all hands on deck to ensure stability in the housing system because of the crises that we're facing.
That makes sense. And then, Nordana, I'm going to pass the same question over to you. I mean, I know you work with a lot of Hispanic lenders trying to make homeownership possible for the Hispanic community. So in your opinion, what are some things that could come from the top down that would help lenders make homeownership and refis more of a possibility?
Sure. Thank you so much, Kelsey, and thank you to the Center for Responsible Lending for your partnership on many of these initiatives as we fight to ensure reliable access to credit for communities of color. I would say that, I mean, to echo some of the things that Steve said, you know, we heard Dr. Calabria talk about the FHFA capital requirement rule, and we share some of the concerns with CRL, for example, on the capital rule, given the fact that the capital requirements will make credit more expensive for communities of color. One of the things that we wrote in our joint letter to FHFA is that the GSEs aren't a bank. They don't hold the same amount of risk. They're focused, whereas banks are focused on providing a number of services and products to consumers. The GSEs are focused on one thing. They're focused on providing mortgages to individuals and shouldn't have the same amount of capital requirements as a bank. And particularly having those incredible requirements during a time when we need all of the resources we can get to have lending be as accessible and as affordable to as many people as possible. We're very concerned. I would also talk about, Steve, you talked about refinances right now, and Dr. Calabria talked about the adverse market refinance fee, the 50 basis points for refinances. And while we appreciate that this fee was extended until December 1st, right now we're seeing a lot of communities of color, especially who have been disproportionately impacted by COVID-19 layoffs, looking to refinances and looking to capitalize on the low interest rates right now in order to make ends meet. What we see in Latino families, for example, is that many of them live in multi-generational households and they might have several income earners or wage earners in a household. And if one loses their job, they're able to still afford a mortgage if they're able to refinance. But this adverse fee could really set many communities over the top, particularly as we're dealing with very expensive markets and a concentration of communities of color in expensive markets. So I would say that, and also we're very concerned with FHA and FHFA's decision not to insure loans that went into forbearance after closing, but before they were funded. This is contracting access to credit and is making lenders much more conservative in their lending practices, in implementing overlays, making credit score requirements more stringent, making debt to income ratios more stringent. So many of these issues are things that we can work on right now to repeal in order to provide access to credit for these communities that need it most today.
And Kelsey, if I may, it would be a travesty of justice if during this time low wealth families are not able to take advantage of these historic lows and are able to refinance their mortgages. Many wealthy families are actually using loan refinances as a way to save costs on their monthly fees, their stable monthly costs. Lowering a mortgage by just a couple $100s will go a long way for many Black and Latino home buyers during this time and homeowners. And every effort should be taken to make sure they can. And we also have to make sure that this kind of refinancing boom doesn't skip Black and Latino people. We already have a situation where the first round of the Paycheck Protection Program, as Mark so eloquently stated, has already gone mostly to wealthy borrowers who are disproportionately white. We cannot have these federally supported with taxpayer dollar relief programs skip our communities.
Yeah, I'm glad you pointed that out, because that actually leads right into what I wanted to talk about next, which is right now, and I think Director Calabria made reference to this, there are about 4 million borrowers who are on refinance, in forbearance plans, but that doesn't mean that forbearance is equally accessible for everyone. A recent Fannie Mae report found that about 60% of mortgage borrowers with incomes of $50,000 a year or less said they weren't familiar or sometimes didn't even know about mortgage relief options that were available to them. The U.S. Census Bureau's Households Pulse Survey indicates that Black and Latino households are significantly more likely to miss or defer monthly mortgage payments or experience uncertainty about the next month's payment than white households. So, I mean, there's going to be a lot of families who run out of parents, can't make those current payments. What more can be done at this point to keep families in their homes and avoid a foreclosure wave, like what we saw in the 2008 financial crisis? And can you, and I'll direct this at Mark first, but anyone who wants to weigh in after that, please feel free. But what role could maybe housing counseling play in helping these people of color or low-income communities to realize what their options are and what different things they do have available to them?
Thank you so much for the question. Housing counseling can play the role of giving people someone to, if you will, assist them in a crisis, to, in effect, represent them and advise them on what their options may be in a crisis. But housing counseling without specific programs like a bank's foreclosure mitigation program or forbearance program, I should say, or without programs that might be funded by taxpayers to assist in paying mortgages, then housing counseling will not be as effective as it could be. You need companion programs at the bank level and also programs at the government level to assist those people who are in trouble, falling behind, and particularly those who've fallen behind because they're laid off. You know, what we have here is a layoff-based. This is not 2010, where there were toxic products at a mass level and people were facing jumps in their payments and teaser rates and all kind of tricky things that all of a sudden caused them to be paying twice as much as they were paying last month. This is induced by this economic coma that is a result of COVID, which is why, and we were going to get this on the long term, I firmly believe that this pandemic and its effects have been made worse by incompetent managing of the crisis. So what we have is a Katrina-like situation, man-made disaster, part natural, part man-made, part natural, part man-made. No national plan to respond to COVID. Therefore, we had a flattening of the curve and now spikes, and then the possibility of additional spikes. And I think that because of that, I believe that in a crisis of this sort, there is a overriding moral obligation by the government, by the taxpayers, by fiscal and monetary, in fiscal and monetary policy, to do what needs to be done to try to help people get across. So what does that look like? Is it a reformulated, much better designed PPP program that's focused truly on small businesses? Is it an extension of enhanced unemployment benefits to give people a bridge, over troubled waters? Is it some programs in the housing area to assist people maybe with refinancing and taking advantage of options, whether it's a refi, whether it's a forbearance, whether it's a restructuring to put the payments they missed on the back end of the mortgage? Whatever it is, the government has, I believe, an overriding obligation, because we should have learned from the Great Recession. Who wants to be saddled with millions of units of REO? And what will happen and the impact on neighborhoods. I see neighborhoods in America that have not recovered from that because of all of these abandoned, rundown properties that were too expensive for anybody to buy and live in rehab. So you're creating more of an economic. It is better to keep people in their homes, right? For the short term, maybe it's 6 months, maybe it's 8 months, maybe it's a year, until the situation can level itself out from a COVID standpoint. And then there can be a truly significant effort to get the economy in a better place. But I do think that housing counseling is a good tool, but it's not enough by itself. It can be very helpful to give somebody, because people say the bank's after me. They're sending me nasty letters. Most people freeze. I don't know what to do. Run and hide, cry, get angry, call a lawyer, file for bankruptcy. What do I do? And what a housing counselor can do is give you, but the government's got a fund. The government made significant increased investments in housing counseling during the recession, which gave us an opportunity to handle the avalanche. We don't have the capacity at current funding levels to handle an avalanche of people who all of a sudden need help.
Yeah, that's a great point. Does anyone else want to jump in on thoughts as to what role housing counseling can or should play during this time?
I mean, I would just add to what Mark said. I mean, under the most normal of circumstances, going through the mortgage process is daunting and intimidating. And you compound it significantly if you are under financial stress. And so I think counseling addresses two of the key challenges in the marketplace. One's the information gap, right? Making sure that people have access to reliable, accurate information. Counselors can play a key role there to demystify and correct misinformation out there in terms of what options are available to a consumer. And then importantly, counselors help bridge that trust gap. As Mark noted, if the bank's calling you and you're behind on your mortgage, you often freeze. But a counselor who's a more trusted third party, you might be receptive to working with them. And so I think counselors can play an absolutely critical role in this environment.
That's a great point. Going back a little bit to refis, we've already mentioned this several times. It's not everyone meets the refi standards to get the perfect interest rates today. So people with less than perfect credit profiles, how can lenders go about making sure that they also have the option to refinance their mortgage and use that as a tool during this time to make sure they're staying in their homes, to make sure they can still afford their mortgage, to make sure that they don't lose out on homeownership because there's better credit profiles out there that lenders are going after? And I'll start with Steve if you want to start.
Sure. So first, the level set. There is a capacity challenge for a lot of servicers in the refi boom. You have record high volumes in a lot of markets because of the historically low interest rates, and so obviously when that happens, lenders are going to prioritize and they're going to deal with the lower credit risk borrowers first because those are the easiest, fastest transactions to process. Those are folks with higher credit scores, more equity, higher incomes. And obviously that means the short shrift's going to be given ultimately to people with distressed credit and less equity. And so there's just a level set in terms of the reality that lenders are facing. But Lorena mentioned this earlier, the loan level price adjustments that are in place on the early payment forbearance front. So these are loans that are closed, but before they're delivered to Fannie or Freddie, the borrower requests forbearance. And for a first-time home buyer, is a 500 basis point or 5% price hit. And for other purchase borrowers and rate and term refis, it's 7 points. That's a significant price hit. So if you're a lender and you are concerned that you might have somebody going into forbearance, and that potentially might be a greater likelihood if you have a riskier credit profile, then you're going to put overlays in place. So to the extent that we get the FHFA, GSEs to work together to remove those price adjustments, I think it would, remove those credit overlays and allow greater access to refis.
Those are great points. Does anyone have anything to add to that? If not, then we'll move on to the next one, which I'm going to ask Lorena. If with Hispanics representing one of the fastest growing homebuyer segments in the U.S., lending to people of color is not just the right thing to do, but sometimes it's the right thing to do for your business. So how can lenders capitalize on this growing segment?
Sure, Kelsey, and I would say that it's the right thing to do for our economy. The future of the housing market is going to rely on communities of color. And I don't know that we've truly internalized this as a society, as a nation. If we look at just homeownership numbers alone, Latinos have accounted for over 50% of the homeownership growth over the past decade, for 50% of the population growth over the past decade. 40% of the household formation growth over the past decade, which is the precursor to homeownership, the data point that drives that signifies demand for homeownership. And you need to understand that the Latino community is young. The median age is 29.8. Latinos are just aging into prime home buying years. And if you look at the population, 1 in 4 individuals that are under 18 in this nation are Latinos. So think about that. 1 in 4 individuals under 18 are Latinos. So if we don't understand that the future of the housing market is reliant on communities of color continuing to purchase homes, then we're really missing a huge economic opportunity cost here. But we need to understand that population. Latinos are purchasing homes with 3.5% down. They are relying on affordable products in order to be able to purchase a home. 40.3% of Hispanic borrowers were under the age of 34, and 69.2% were 44 or younger in 2018, which is the latest data that we have. So we're looking at a very young population. 1 in 4 Latinos is a millennial. So that is the population that we're looking at. We did a study together with Freddie Mac, and we found that there are 4.8 million mortgage-ready Hispanic millennials in the U.S. And some of the biggest opportunity markets are McAllen, Texas. It's Miami, Fort Lauderdale. The New York, New Jersey, Pennsylvania market, the San Antonio market, and the Inland Empire of California will probably have the most of these mortgage-ready millennials. So understanding this population, understanding the need. I know we'll talk about diversity in a little bit later on, but understanding the constructs and the financial profile of these individuals. Latinos still have a median household income of about $51,000. So we're looking at a community that depends on these products and depends on lenders understanding the need to really focus their strategy on this market, and the fact that Latinos are young.
That's a great point. And then, but contrasting that, we seem to see a lot of hunger for homeownership among Hispanics. We see a lot of growth in that area. Like you said, it's a young population that just aging into homeownership. On the other hand, we have the Black homeownership rate, which is starting to just now recover from hitting record lows.
Yeah.
We show, we have record lows, and yet Urban Institute's research shows that there are actually more than 1.7 million mortgage-ready potential Black home buyers in the U.S. today. And Freddie Mac estimates that figure is actually closer to 3 million when you add in all age ranges from different regions across the nation. So given that data, what can the mortgage industry do? And I'll direct this at Nikita. What can the mortgage industry do to convince these potential home buyers that they need to purchase a home?
Thank you for the question. And this is where I have to really take issue with the comment that was made earlier by the director. We know that many families of color were steered into dangerous and abusive toxic mortgages when they actually qualified for credit on far better terms. So this idea that they were kind of less worthy of home ownership, or were the perpetrators of kind of the foreclosure crisis is just not fair. We know that most of those foreclosures actually came from borrowers who were mostly wealthy in the Alt-A system. So we just need to clarify that point as we talk about Black homeownership. Black homeowners have never really had a housing market that's been entirely fair. It's important that you highlight that there are almost 3 million potential home buyers who are not entering into the market. And we know that part of that reason has to do with historic inequity in housing. Because of residential segregation, Black Americans have not been able to build wealth parity with whites. Whites could really use their home equity to help finance their kids' education and to provide the launches of small businesses. That's something that was not true for Black Americans. Only 2% of FHA insured mortgages in the first 35 years of the program went to families of color, 98% to white families. So when we're talking about Black families, they're just going to show up with heavier debt loads, right? We all need to get an education to advance in the society. That's part of what is heavily promoted. So Black students show up taking out larger levels of student loan debt. It is a major impediment to students and their ability to finish school and then to save money for a down payment. So one of the things we need to do is we need to just have a massive kind of student debt forgiveness at about $20,000. We know that even $10,000 could be sufficient to really take this debt burden off of Black students and help them to really convert their incomes into down payments for their mortgages. We also know that millennials are starting to enter into the marketplace. So lenders have to be more aggressive in their marketing to this important segment. Like Narena mentioned, the Black population is also very young. And there is a lot of potential there in terms of strengthening homeownership for that population. We also need the CFPB and its QM rule to not overly rely on debt to income. Because of the historic discrimination that I just spoke about, we show up with higher debt burden. So if debt is the single determinant, and if I can have an ability to repay the mortgage, that's going to really negatively impact African Americans and Latinos together. And then pricing continues to be a major concern. What FHFA might do with its capital rule has a big impact on who's going to be able to afford a mortgage. And we need to make every effort possible to ensure that it doesn't disproportionately hurt Black and Latino families. Fannie Mae and Freddie Mac have an important governmental mission. And in order to meet that mission, FHFA has to ensure that the pricing is fair.
That's a great point. And, you can't talk about finances or even the mortgage industry without talking about culture. And I think that that's something that we haven't had to focus on in previous generations, or maybe we should have focused on but didn't. But now it's really coming to like there's so many different cultures that we have to take into account, and the same way of lending may not work the same for every kind of borrower. And that's definitely something that we need to start looking at. When my
And
husband,
even to that point, Kelsey, Black and Latino borrowers show up in the mortgage market, and we know that the pricing still has a disparate impact on them. Just last year, Hofstra's Institute at Berkeley did a study that showed Black and Latino borrowers are paying an additional $765 million in pricing disparities to get their mortgages. More has to be done to fairly enforce the fair lending laws and to stop those practices.
yeah, for sure. And I think definitely enforcing what we have already in place is definitely a starting point. Even before we start looking beyond it, at what more can we implement. You can start.
And let me say something about enforcement. Enforcement is easy. It simply requires the right people in the right seats to take the law seriously. One of the ways in which civil rights is being undermined, and it's being undermined by the current administration, is just a fundamental decision, an executive branch decision being made. We will not enforce civil rights laws. We will not enforce fair lending, fair housing. We won't enforce the Voting Rights Act. We won't enforce the Rodney King pattern and practice police provisions. We just won't enforce them. And it's distressing because it's an insult to the work of Martin Luther King and John Lewis and Whitney Young and all the men and women, Lyndon Baines Johnson and that generation who struggled mightily and turned the tide of this country by putting a whole body of new law on the books and entrusted the Justice Department and the HUD and the Department of Education to enforce these laws and enforce these rules. And there's been an assault on it of tremendous and immense proportions. The problem we face in the country is that we have to, addressing the problems in the housing market are a way to abate the country's long-standing racial wealth gap. And this long-standing racial wealth gap is corrosive. It creates political instability. It turns the United States into a caste society where people are just stuck wherever you're born. You can't move up. Very few people can move up, which is completely inimical to the notion of the American dream. The American dream's proposition is that you can move up. You can move up because we have opportunity. We can move up because you devote yourselves. You can move up because people are there and institutions are there to support you. And these issues are so much bigger than housing. I mean, you all are familiar with Matt Desmond's book, Evicted, right? Which is a seminal book. And what shocked me was the idea of how much worse the rental situation for most Americans have gotten just since 2000. Like we've had a deterioration in the 21st century where now you've got legions of people paying 50% of their take-home pay in rent. This is not sustainable. It just is not sustainable. And we see in the protest in the street, while the death of George Floyd was a trigger, and the underlying issue is a people petitioning for redress of broad grievances. And those broad grievances are lack of economic opportunity, lack of access to capital, lack of the ability to be educated without going into debt for 50 years. These broad issues. And so when we speak about this is why we need enlightened voices, and Steve, you've been one of these in the business community that recognizes that addressing these issues is crucial for the body politic. All that to say, I want to see in January a broad, comprehensive, big picture plan around housing. to build more housing,
Yes.
to make mortgages more affordable and available, to enforce the rules and enforce the laws, to be intentional about Black homeownership, to be intentional about Latino homeownership, very intentional about it, very specific about it, not to the exclusion of anyone else, right? That's not what this is about. It's about we have to be intentional if we're going to level the playing field. The result of it is you prime the pump on demand, and you're going to create a tremendous amount of jobs and opportunities and hope and neighborhood energy if you do it in the right fashion. But we've not had a comprehensive plan around housing that deals with all of the elements, some regulatory elements, building elements, neighborhood transformation elements. And that's the moment we are. And I think that's what the public and the people are crying for. I'm not, one who's at this stage, I can't get enthusiastic about incrementalism, about baby steps, because the times require so much more. If you read the mood of the people, if you read the energy of the people, if you read, and it's not just on the left, some of the resentment on the right is fueled by economic issues, even if we have a typical thing that happens in American history when people lack economic opportunity. Sometimes we point a lot of fingers. I don't have it because that one's got it. If they get it, I won't get it. And that's why we need a big picture plan, a big picture energy around, around housing. I think housing is any infrastructure plan that they're going to consider has to include affordable housing. We all ought to unite, on that and say, I don't want to just pave roads. I don't want to just fix highways. I don't want to just see us build beautiful bridges. I want to see schools get built. I want to see houses get built. I want to see parks get built where people live. And that's the kind of infrastructure. So that's one thing we can unite about. We're going to, have to figure out a lot of details in between about how you ensure that it's absolutely equitable and that there's opportunities for all. But we have to think very big. We are in a rut. We're in a hole. We're in a bad spot as a country. We see it playing out, and I think we have to unify and unite about this. I mean, you guys we all been in this business, in this work for a long time. We were talking about GSE reform 10 years ago. I mean, like scratching my head. I've lost track of the chapters in this long-running saga, right? We've been talking about this, and then I'm almost stunned that after going through the foreclosure and the bank crisis of 10 years ago, here we are with another avalanche of foreclosures and evictions on our doorstep. And I mean, we thought maybe, we'd go through that maybe once every 25 years, not once every decade, and the severity of it. So I think we can unite around, embracing a big comprehensive picture, lots of things to fix, and not just tinkering around the edges or dealing with incrementalism. And I think we have to demand of our leaders, after November 3rd, we have to demand big picture thinking. We have to demand what the times call for, and not just an incrementalism and tinkering around the edges, because we're politically concerned about whether we can put it all together. We've got to put it all together.
I'm glad you brought that up. I know politics can be a risky subject to talk about these days. But I actually did want to ask y'all about the races it's going right now. We have two very different candidates, very different things. One has made housing a major issue or even an issue at all. We see there are two different approaches to the industry as a whole, to the economy as a whole. So, and Mark, I know you went through some of the things you would like to see. So if the rest of you, Nordana, Steve, Nikki, if y'all all want to weigh in a little bit, what are kind of some of the pros and cons that you see for the platforms for each political party.
Yeah, I wanted to piggyback on Mark, what you said about building homes. We need to build homes. And first of all, it's an honor to share a stage with you. But the conversation around building more homes is probably the civil rights issue of our era when it comes to zoning reform and things of that nature. And when it comes to housing, we're seeing this culture war play out in the media right now about this protection of the suburbs and what that means and all of the racial implications that go with that. But I was very pleased, speaking of which, and talking about big picture, I was really pleased with the Biden plan's ideas for how to tackle some of these zoning issues that we're facing in the market today. One of the things that I was particularly pleased is seeing that the proposal to have transportation funds be contingent on municipalities reforming some of the restrictive zoning policies within their cities. That's something that I was very pleased with. And we, tackling affordable housing and building more housing has to do with zoning, has to do with immigration reform, because we have a labor crunch when it comes to construction. And it also has to do with some of the tariffs that have made materials so expensive to build homes. I was very pleased with the first down payment tax credit that would give first-time home buyers a $15,000 tax credit that they can use right off the bat to pay for their down payment. So that I was pleased with. In terms of the Trump administration, definitely we're seeing a lot of rollbacks of critical fair housing regulations such as disparate impact and affirmatively furthering fair housing, which we think is very problematic. Although we are pleased with the direction that the CFPB is going with reforming the definition of qualified mortgage. And we do believe that with the right caveats, we can expand access to credit with some of the reforms that the CFPB is introducing. So that's my lay of the land, my favorites and least favorite things of the two plans.
So I respond by saying that fair housing is a nonpartisan issue, and I'm grateful for Mark and Lorena for mentioning our nation's fair lending laws. We've got to remember that discrimination actually hurts the economy. McKinsey and Company did a study that showed that if we actually address discrimination targeted at African Americans, we have a chance to grow the economy 4 to 6% and our GDP by $1 trillion to $1.5 trillion by 2028. So it's actually in our economic interest to stop with this discrimination. So any administration needs to make sure we have leaders put in place who have already demonstrated a commitment to fair lending and to fair housing at the outset. This can't be a kind of train on the job situation. We need people who actually know how to get it done, put into place. We also need to be sure that we're fighting for an equitable recovery. I think you heard all of us in our remarks today express some level of concern that not enough is being done to ensure that this recovery is equitable. So any new administration has to do everything in its power to make sure that Black and Latino families actually get their fair share of these stimulus relief sources. And we cannot have a situation where the first round of the Paycheck Protection Program becomes our status quo. We actually need to see those families, those business owners get direct government grants to help those Black and Latino businesses. We saw 30% and 40% of Latino and Black businesses close. We cannot have a healthy and just economy if that's the outcome going forward. And then finally, we need to, in terms of putting a concept on Mark's idea about a broad government program, we need a GSE restorative justice home loan guarantee. We're talking about at least $50 billion at the outset for significant affordable housing, including access to home ownership. And there are many ways that the GSEs can pay for. You know, we're all pretty smart and we can work with other pretty smart people in figuring that out. But starting that conversation with a minimum of $50 billion is significant, especially in light of the fact that right now, Fannie and Freddie's GSE activity supported for Black home ownership is less than 4% and less than 9% for Latinos. So much has to be done to really help close those gaps.
Great.
Steve, did you have anything you wanted to add to that?
No, I mean, I think Norena was absolutely 100% right when she talks about the challenge of increasing housing supply. We'll give the Trump administration some credit for the White House task force on removing regulatory barriers for affordable housing. That's kind of the, approach that this administration has taken. The Biden team, if they capture the White House, are likely to take a much more activist approach and look at subsidies. And Norena talked about that. But I would. And they both have their virtues. I think ultimately it's going to be a combination of those approaches. I do think that regulatory reform can be a key part of the equation, but just bear in mind that there are other pieces of the equation that we need to think about. One is, the personnel that Biden might bring in. Personnel is policy, and you have the potential turnover in the Trump administration if they get a second term. So that will be a key factor. And we don't know where things are going to be in terms of COVID-19, both on the public health front and on the financial and jobs front. So that's going to present a whole set of challenges, and we don't know exactly what those are going to be. We know that they're going to be significant. And then last and not least is Congress. What does the new Congress look like after the election? And if there's a blue wave and Biden captures the White House and the Democrats take the House and the Senate, you could have a significant sea change in housing policy. So there are lots of different options, but I think the issue of supply and, to Mark's point, a broad, aggressive, holistic approach to these challenges is absolutely spot on. That's what we need.
Yeah.
Those are all great. So I want to remind everyone who's watching, we have we're taking questions. So if you have any questions you want to add, feel free to reach out. Those questions, it's not directed at anyone in particular, so feel free to grab it if you want. Is what can we do as allies to advocate for better opportunities or barriers? And how can we make this issue come to front? So many issues are reported right now.
Hello?
Yeah, the question was a little choppy, at least on my end. I was having a hard time.
Yeah, I had trouble hearing it too.
Okay, that's again. So people are wondering, as allies, what they can do to make these issues come to the front when there's so many other important issues right now.
Well, I think it's been stated that many of the social issues that we're grappling with today are interconnected. Residential segregation is at the root of many of them. Solving these issues is actually part of the solution for solving those. Many people don't even realize that the OCC permits CRA credit for the building of new police stations. I mean, that's a basic thing that we can all champion. That's not really the healthiest solution for communities at this moment. So we've got to talk about housing as infrastructure and as opportunity, as has already been discussed.
I would add that just from a citizen role that you can do is show up to your city council and talk about zoning, because you bet that there are dozens, if not hundreds, of what we call not in my backyard advocates speaking up at city councils, flexing their muscle at the state legislatures, and there aren't there are not enough people on the other side speaking up about the need to ease zoning restrictions in order to build more housing.
That's great. So then the next question I have from the audience doesn't get very specific. They just say, how about disabled individuals for housing ownership?
Kelsey, please repeat the question. It didn't come through clearly again.
Sure. So I said the next question doesn't get very specific. It just says, what about disabled individuals for housing ownership?
Absolutely. The Fair Housing Act covers people with disabilities. They are a protected class, and that's part of what it is we're fighting against in terms of the rollbacks of the fair housing provisions that had been discussed. We need people to have a fair shot at the American dream, and that includes all people that have historically been denied.
And then, so I'll just ask one question before we run out of time here. And that is something that was alluded to earlier, several times actually. That ownership is so the ultimate goal is for people to build wealth. But what about renters right now? I think we would be remiss to not talk about that. I'll focus a little bit on how they're disproportionately impacted by job losses. What policies are needed to put in place right now to make sure that they don't lose their homes once the moratoria ends?
Mark alluded to this earlier. There is definitely action that needs to be done to stop us from going over the rental eviction cliff. Housing accounts for 20% of the economy overall. We know that 53% of the total rental market is actually single family properties, 1 to 4 units. So we need to do everything that we can to keep those people, one, from a public health perspective, safe in their homes, and then also from an economic perspective, safe in their homes. Even before COVID, a quarter of Americans were actually paying more than 50% of their income in rent. And that was 30% of African Americans and 30% of Latinos doing that. So we need the HEROES Act, $100 billion that's targeted rental assistance so that we don't go off of a cliff. If we have disruption in the housing sector, we should be sure it's going to reverberate in every region of the nation.
I would add, and Mark, you alluded to this earlier, that we're also dealing with small landlords. And many of these small landlords are communities of color who don't feel comfortable investing in the stock market, but if they have extra money to invest, they invest in a real estate in a couple of units. And we can't just keep kicking the can down the road and not think about the implications that these small landlords are facing as well. If you think about it, if this small amount of wealth that's been built in these communities of color, if these individuals lose all of their homes, you better believe that investors are ready with cash to up all these properties up as soon as these communities lose their homes, and those properties and that wealth is not going to come back. So you have to think landlords and tenants are in this together, and we have to think about it holistically as we face this pandemic.
Yeah, there's no doubt. I mean, one point I wanted to make, and this is always a factor in housing policy. Housing policy cannot be separated from, I think, what I call the broader underlying long-term challenge that the American economy faces. And that is, we have been on a slope where maybe 70% of those who work in the American economy have not seen their earnings keep pace with inflation for the last almost 35 years. So that leads to many people who say, man, I am working and I have a job and I still can't make it. I still can't put ends together. So we have this is such a fundamental shift from the American economy of the 1950s, 60s, and 70s. It really is. And there are many reasons for it, but I point it out because, no matter what you do on the mortgage side, if people simply don't earn enough to meet debt to income, even relaxed debt to income ratios, they don't make enough to save anything, then they're never going to get in a house. And I invite everyone to look at two numbers. Go look at from now, from 2000 to today, average household income, and then go look at average rents and average home values. And it tells the complete story. where average earnings have been flat for the most part, with people paying rent. I think the average rent's gone from like $600 or $700 a month up to $1,400 a month. So this is why housing advocates have to be in the conversation about minimum wage, about earnings increases. You just miss the boat if we don't recognize the need to address those issues also.
Yeah, thanks for that. Housing definitely plays a major role in how we go about that today. We've seen even now that's starting to be concerns is that as lending is more popular, as these rates get lower, home prices are going up because it's going to buying up those homes. But at what point does those become unaffordable, and will that home price growth be unsustainable? And of course, you know that when prices are going up, that's also going to push the rental prices up for what they can afford as well. So it's definitely something to keep an eye on and be advocating about. So thank you, everyone, for being on our panel today. Thanks for joining us. This has been really informative. So thank y'all.
Thank you so much for being our moderator, Kelsey, and thank you to our co-panelists. We greatly appreciate each of you, and to Mike for sticking around with us this afternoon and hosted the portion with the Director Calabria.
Mike, this is the first time I've ever been in a meeting with you, but I didn't hear one quote. Not a single.
I learned a lot. I'm gonna learn to turn those phrases and simplify it and frame it like you do, Mark.
Lakeisha got it all. Yeah, she handled the brilliance end of this conversation.
She did.
Thank you, and our other panelists did as well. We're grateful to each of you, and we appreciate the partnership.
Good to see you, Norina and Kelsey. Thank you.
Thank you for doing this. Steve coming right back from vacation.
Steve,
we appreciate that.
Steve, you're hiding.
You didn't lose a step.
Still here. Thank you.
Thanks, Noreen.
Thanks, Steve.
Thank you, Kelsey.
Bye, Steve. Bye-bye.
Thank you so much.
Take care. Great job, Kelsey. Thank you.